rolling. So we're going to get started on Monday. So that's the first day of the week. So Monday the 13th of March. So with the daily analysis, now if I remember at the beginning of the week, I did mention that bias was predominantly going to be bullish. The reason being is that Friday, we did see that second session of rise. Price took out key buy side targets, but also price was very close to taking out these relative equal highs. So I do remember very clearly on Monday, the bias was predominantly going to be bullish as we were within a bullish part of the cycle, right? Now, of course, the sell side, the next draw on sell side was the imbalance that was residing below. And the next draw on buy side was obviously going to be the swing high right here. The swing high is pretty much the same as the set of relative equal highs that was residing just above. So I'm just going to quickly draw that out. Let's get rid of it. For whatever reason, my PC has been incredibly slow today. That's a bit weird. All right, so going on to the 4 hour. So I'm just going to forward play this onto just the 1 a.m., just the pre-open market. There we go. And I remember obviously this week we did have that change in time. So the London open went from 2 a.m. to 3 a.m. And then, sorry, the European Open went from 2 a.m. to 3 a.m. New York time. And then the London Open went from 3 a.m. to 4 a.m. New York time. So that was something to have been aware of at the start of this week as well. Okay. So the daily range, the high of the daily range was pretty much the same as the 4 hour. So the H4 and the daily buy side target were exactly the same. And then for the sell side at the time for the 4 hour was the same as the imbalance that was residing just above the daily buy side target. Okay. So that's the H4 sell side target. And going to the 1 hour. All right. So now going into obviously the trading session. So I'm just going to forward play this twice. Right. So obviously 3 a.m. was the open of the European session and 4 a.m. was the open of the London session. Now, the most important levels when doing your analysis is the 1 hour and the 4 hour levels. These are the key levels because at the very minimum, price needs to have taken out at the very minimum the H1 buy side or sell side target, as well as traded outside of the Asian range before looking for any kind of setup. Okay. So we have here the H1 buy side target. And then just below, we have the H1 sell side target, which is the imbalance that remains open. So just to adjust the labels on this. Perfect. Once that's done, next is to identify the Asian range. So as you can see, my analysis is still there from the day of trading. So you can already see what the Asian range already looks like. We have the high was quite a big range in this trading session, with the high of the range being right here, and we had the low of the range being down here. And we can see the price came up near to the high of the range, didn't quite retest the high before contracting. And then just before the open of the European session, what happened? Well, we can see that price vector accelerated outside of the range, right? So I'm just going to bring back the London and European open lines because these are, again, when you're doing your analysis, always make sure that you have those vertical lines that indicates the open and close of the session, okay? So this line is our 3 a.m. line. And this is our 4 a.m. line. Okay. So European Open price had broken outside of the range. So what you can anticipate in this scenario is either going to be a BRR or a BRC, so a break retest reversal or break retest continuation. Well, the most important criteria that wasn't met was for price to have traded into a form of sell side target or buy side target. So in this case, by the way, this is meant to be H1 sell side target, not buy side target. But in this case, what we can see is that price traded into H1 sell side target during the London Open. Okay. So if we were going to get a BRR, what did we want to see? Well, within a BRR, we would have needed to have seen price taking out the high of the range first in just before the London Open or at the beginning of the London Open. And once we see that price takes out the high of the range, then we can anticipate some form of a reversal. But why is a BRC a lot more likely? For two reasons. The first reason is because the daily is still predominantly bullish. We've seen 2 sessions of rise. The second reason is because price is trading into the bullish order block. So the bullish order block is this red box, right, at the beginning of the session. Now, there are 2 ways to trade break retest continuations. The first way to trade a break retest continuation is to, as soon as price trades into the order block and takes out the low of Europe, the European Open low, is to look for an entry opportunity, right, at the beginning of the session after price has traded into the order block and take it out the low of Europe, okay, of the European Open. That is one AOI. So the first AOI is price is taking out short-term low, price is traded into an H1 sell side target, right? At this point, looking for a entry opportunity is valid, okay? So in this case, what did we have? Well, we had a classical break of market structure on the 1-minute time frame, right? So price came up, gave a classical break of market structure. Optimal entry was, of course, going to be this last down close candle, right? So the general idea was to have taken an entry at the last down close candle. Stop loss goes 5 pips below the low. And there we go. Stop loss goes 5 pips below the low. Now, what is the next criteria that determines if we have a setup or not based on our entry and stop loss placements? Does anyone know the answer to that question? So what is the final criteria that we need to know with a BRC that determines if we have a setup or not? Correct. So we need to identify, that's correct. So we need to identify that the risk to reward ratio is a 1 to 2 to the minimum target. So the minimum target is the most appropriate target within the range. The most appropriate target is going to be the recent high. So with BRCs, the first target is almost always going to be the recent high, and the second target is going to be whatever buy side target that comes after that, whether it's the H4, the H1, or the daily buy side target, but the recent high. And in this case, the recent high coincides with the 1 hour buy side target. So the long to the recent high was a 1 to 2, right? So that obviously ticks the box in terms of, do we have an appropriate risk to reward to the minimum target? And then after that, you can then set a second target at the 800 EMA if there's one residing just above it, or you can just set a second target to the daily high, which is the next draw on buy side liquidity. Now, I remember clearly this day because obviously this was the initial setup that presented itself. It was a very clean confirmation. So there's absolutely would have been no issues to have gone long in this scenario. But then obviously what happened thereafter was that price came down, hit the stop loss, and that was it. Now, here's the thing. The most important part of having a solid trading plan is not only accounting for good setups, but also accounting for how to and where to identify re-entry opportunities. Because the majority of time as a trader, you are going to get setups that you enter once and that's it, it works out. That's fantastic. Those are fantastic days. You're not always going to get that. So a lot of the time, you need to be looking out for opportunities where price will stop you out. But when you understand why you got stopped out, it's easy to identify where to re-enter. So 2 types of BRCs. The first type of BRC is where price retests the order block perfectly, gives a setup, and then bounces off that. We had an example of this that took place last week. The second type of entry opportunity you get is after price takes out the low of the order block, which is the short-term low, so the low right here. So I'm going to say that again. The only 2 opportunities that present itself with BRC that are good opportunities to trade is the initial order block retest opportunity that provides an entry opportunity. If that fails, the last thing that you want to be doing is to be re-entering every time price breaks market structure on the 1 minute within the order block. Because you will get situations like this quite a few times where it looks like, oh, prices came down, broke structure again, and you re-enter and then get stopped out. No, you don't want to do that. If the first entry confirmation fails within the order block, then the only thing you need to do is wait for price to take out the low of the order block before attempting a re-entry, because that is the only other time that a BRC setup works out really well. Okay, so the first opportunity fails. So at this point in time, there's one of two things you can do. You can either call it a day, that's it, not take any more trades for the day, or you wait and set a price alert for price to take out the low of the order block. And then, where if price was to give a reconfirmation to go long, take it, right? So in this case, what do we see? We see that price gave another break of market structure right there. So this is a classical break of market structure, okay? Just notice how price obviously traded and left this and obviously closed back into the range. So therefore, our area of interest to enter is going to be what? It's going to be the last down close candle. Okay. So the long opportunity that presented itself for a re-entry was from the last down close candle. Stop loss goes below the low, 5 pips below the low to account for spread in case price comes down to take out the recent low. And then the first initial profit target is going to be the H1 buy side. And notice how the re-entry has a much better risk reward ratio. The first one was a 1-2, second one was a 1-5. So not only if this works out, would you make your money back, but you'd also make a very nice profit on top of it as well. So after the second confirmation, again, took a re-entry at the bullish order block. Price came down, triggered the position, and then like just hung around the area for a bit before eventually running away, right? So it was late in the New York session. So it's like around sort of 11 a.m. New York, going into sort of New York afternoon. That's when price traded into the profit target, right? So that was Monday setup. So Mondays and Fridays, like this is what I mean when I say Mondays and Fridays, you know, sometimes you need to work for those trades, right? You need to work for that win, right? But it's about being disciplined. It's about knowing what to look for and knowing what to wait for. So if you took that initial entry and you got stopped out, that's okay, because if you would have taken it under the right conditions. But after that, the only other valid re-entry would have been after price took out the low of the range. So you do not take re-entries within the order block after price takes out your initial entry that was solid, right? If price gives another BMS, don't take it. That's not a BMS, right? Because remember, with break of market structures, the most important thing is context, right? So that was Monday setup. So Monday was a break retest continuation. It wasn't, of course, a straightforward move from the order block from the initial entry, but within the London Open, just toward the end of the London trading session, price gave a reconfirmation after taking out the low of the order block and then traded into the most obvious target, which is the recent high. Okay. Does anyone have any question about Monday's setup? Right. Absolutely. So you're still looking for the same confirmations on the indicator, and I mean, it's right now my laptop is being, I think, because I'm running multiple programs recording this as well as running Discord and TradingViewer, so it's taking a bit of a hit on it. I would have opened my see if I can. Now I'm worried it's going to slow my PC down, but there was actually, yeah. So there was a confirmation. So the initial confirmation ticks all the boxes. So you had the break of market structure, a classical break of market structure. You had a shark fin on the TDI. You also had divergence on the TDI as well, and price also closed above the 13 EMA after giving the confirmation, right? On the second reconfirmation, you also had all the indicator entries, such as shark fin on the TDI. TDI was in massive extreme at that time. There was also a divergence between this low and the initial low that was created there in the European Open. It was a massive divergence. So again, like all the right boxes were ticked, and then after price gave the initial confirmation, it closed above the 13 before coming down to retest the order box. So again, like it ticked all the right boxes. So even with the re-entries, you're also still looking for the right set of confirmations. Okay. No worries. But yeah, so this is one of the most important things to really have noted for BRCs, right? If you took an initial entry in the order block and that didn't work out, do not take another entry within the order block. Always wait for price to take out the lower, the high of the order block before looking for another entry opportunity. That way, you're not going to get stopped out multiple times for no reason. Okay. All right. So if no one has any other questions, I'm just going to move on to Tuesday. All right, so Tuesday, obviously Monday, we'd seen that nice push into a daily high. Again, just notice price action. It's very logical. It goes from sell side to buy side to sell side. That's the cycle of the market. So we've seen a move from sell side, which is obviously below this low within the monthly imbalance, within our weekly sell side, going into buy side, which is above the set of relative equal highs. So now what's the next logical move? We've seen 3 days of rise. We've seen price traded into an area of massive buy side liquidity. And we've seen a very strong bullish close above that high. So the next logical move the next day is to anticipate some sort of move towards sell side liquidity. And that could happen in either London or it could happen in New York. Okay. So what are we now looking for? We're looking for the same signs. So number one, we identify the next draw on sell side on the daily, which is the imbalance, and the next draw on the daily, which is going to be the swing high right there, which is already labeled the same high at the weekly high. Then we go to the 4-hour time frame. Just going to forward play this. All right, so we have the 4-hour buy side target, which is going to be the swing high. And then we have the H4 sell side target, which is going to be this imbalance that's residing below. So going on to the 1-hour time frame. What are we now looking for? Same thing. So I'm just going to forward play this 2 hours. So now 3 a.m. is the open of the session. Just move that there. And then 4 a.m. is the open of London. There we go. So the next draw on the 1-hour buy side is the swing high. And the next draw on 1-hour sell side is going to be the swing low down here. And I remember this day because I identified the imbalance initially, and John had highlighted that, price had traded into that imbalance before because I was using initially the 2 a.m. timing instead of the 3 a.m. timing. So that was a nice spot, John, at the early of the week. So I'm just going to quickly correct this, the H1 sell side target. All right, so going on to the 15 minutes time frame. So again, identifying that Asian range is absolutely key, because without the Asian range, you don't really have much of a setup. So I'm not sure why my Asian box disappeared. So Asian range on Tuesday was pretty straightforward, right? Where we had the high of the range being the swing high right there, and we had the low of the range being the swing low down here. We can see the price accumulated around the range quite a bit, traded out, traded back into it, going into the European Open. Price then began to move outside of the range. So what kind of setup were we anticipating for this day? Well, this day you had to be really super focused, right? And I remember this day where price was pretty much just trading around the range, even in the London Open, right? But there's one thing that's incredibly important to know. You're only looking for, and Gemma, this is for you, right? You're only looking for a breakout of the range during the, so you're only looking for a breakout of the range on the 15 minutes time frame. So I'm not looking for a breakout on the 5 minutes or the 1 minute. The 5 minutes or 1 minute is strictly reserved for looking for entries, right? So before I look for an entry, I'm observing the 15 minutes time frame, looking for a breakout. And how do you know a breakout has happened? Simple. Price has traded outside of the range and closed outside of the range. And you want to see that for 2 consecutive candles, okay? Because why? Because price can close outside of the range in 1 candle, trade back into the range the next candle. That's a railway track. That's a trap. That's not a break. That's a trap. And did it again, broke out of the range, traded back in. Again, that's another trap. So, and again, when you see price trade out, always wait for the candle to close. Don't just assume, oh, price is out of the range, it's a break. No, wait for the candle to close, because why? Price could simply trade back into the range, closing. That's another trap. So you want to not be, you do not want to be in the market when the market is trapping around, right? That's a basic. The price was trapping around for quite a bit, for quite a few hours, actually, I think 2 hours into the London Open. It was just staying in the range, right? And then eventually, right? Eventually we saw this, right? But then this happened after the trading hours was over. So this happened just around 7 a.m. in the morning, which is my trading cutoff time, right? 7 a.m. New York time, you're looking at around 11 a.m. At that time, you're not looking for any more positions. So on Tuesday, there was no setup at all whatsoever, because price was simply trapping around the range for the duration of the trading session. And then it was in New York, because remember, why is it important also to not be so hungry for trades, especially at level threes within the cycle? Because level threes are accumulatory parts of the cycle. So you should always expect some sort of accumulation after price is given 3 or 4 sessions of price rising or falling, right? You should always expect at least price accumulating in London. So within accumulatory sessions, it is usually expected for price to behave exactly as it's behaved on Tuesday. And then in New York, it again did some really random move and only just ended up trading back into the range. So Tuesday, there was no setup whatsoever, because price was just trading around the range. Although, yes, it did take out the H1 sell side target, right? It didn't give any break outside of the Asian range. So therefore, Tuesday, there was absolutely no setup at all. And that's okay. So Monday, 1 to 5 after a re-entry. Tuesday, no setup, no problem. But then let's imagine you forced to trade and you took a loss. Now you would have given back money to the market for absolutely no reason whatsoever. So any questions about Tuesday? Perfect. One of the realities of day trading is you have to show up every day. Doesn't mean there's going to be a setup every day. And that's fine, because usually the day after that or the day after that tends to make up for it. So you should always be happy to sit in the market, to sit on your hands, wait for an opportunity, and for there to not be a setup. That shouldn't be a problem, because not for a fact, but know that there's a very high likelihood that the market will make up for it the next day or the day after that, and you just need to be patient. So Tuesday, there was no setup, price accumulated as we usually would anticipate within that third session of rise. So going into Thursday, what can we now, and going into Wednesday, what can we expect? We can now anticipate some sort of reversal, because why? We've had a third bullish rise. We've had a session of price accumulating orders. So it makes sense that we have a shift in the next session, right? AMD, accumulation, which is this, manipulation, and then we have the distribution part of our cycle. So I'm anticipating some sort of bearish reversal going into Wednesday. So again, what are we looking for? Looking for the next draws on liquidity. So on the daily, this is the next draw on sell side. Same draw on buy side on the daily. Going into the 4-hour time frame. So just going to forward play this to just before. So just before, we had a draw of buy side liquidity on the 4-hour as the swing high, and the next draw of buy side of sell side liquidity as the swing low down here. I'm just going to get rid of the imbalance. Going on to the 15 minutes time frame. Right, we can now see that where our ranges are. So again, I'm just going to just pull these lines forward just to indicate the open of the European session, which is at, 1 second, just pull this forward a bit more. Sorry about my laggy laptop. I don't think I've switched it up for the whole week. That's why it's lagging around for a bit. Right there. And then I'm going to move this. let's go to the 1 hour. There we are. Right. So we've had the whole session of accumulating the day before, going into the European Open. Remember, price was pretty much within the range, right, for the open of the session. All I wanted to see in this case was one of two things. Number one, for price to trade outside of the range and for price to take out the H1 sell side target as a very minimum. Okay. Now we can see that price traded into the H4 sell side target. We can see that price traded outside of the range. But again, remember what I said earlier. You don't just want to see one candle closing outside of the range, right? You want to see two candles closing outside of the range consecutively for you to have a breakout. The next candle closes back inside of the range. And the next candle after that closes outside of the range, but then immediately pulled back into the range. So again, you don't have a break, okay? It's important you wait for the candle to completely close. Next candle did the same thing, traded outside of the range, immediately pulled back into the range. So again, going into London Open, I remember sitting patiently waiting to see what happens. And again, I know that the setup to anticipate today was a break retest continuation. Why? Number one, the daily bias was bearish. Number two, price is obviously traded from the high of the range to the low of the range, and obviously looks like it's creating some form of an order block. The only thing I needed to see to verify that order block was for price to give me that push outside of the range. Once you have that push outside of the range, then you have an order block, right? But if price is accumulating, because remember, what are order blocks? Order blocks are areas of accumulation, right? That's literally what order blocks are, the areas of accumulation. But you only have an order block or an area where there is a bunch of orders sitting only after price has traded outside of that area, right? That's when this becomes an order block. But if price is still accumulating within a range, then you simply do not have an order block, right? So yes, this is an area of accumulation, with obviously this being the low of the area and this being the high of the area. So this is my order block range. But because price was still accumulating within that area, there wasn't any order block defined yet. So I was waiting for price to define that order block by trading and closing outside of the range. So yeah, we have two consecutive candles. Candle 1 and candle 2 have now firmly confirmed that there's a break, okay? So now I remember in this case, I was like, okay, now price is broken out the range. That's sweet, that's fantastic. What's the next thing to wait for? Or the next thing I'm anticipating now is for price to trade back into the order block and to provide that 1 minute confirmation short. But what happened? Price just went, nah, I'm not going to do that. I'm just going to keep on running into the direction that I want to go. But that's fine. I've seen this happen quite a few times where price can trade outside of the order block and simply run away, okay? Usually price can come back sometimes, but not always. But what is the most optimal setup in the scenario? The most optimal setup in the scenario is to wait for price to trade into the order block and to sell from the order block, right? I know someone has asked me this before. Is it possible for price to do what? Is it possible for price to trade into the order block, right? And then, no, so is it possible for price to trade away from the order block and then you go long towards the order block? Someone has asked me this before. And I say, yes, it's possible to look for a buy opportunity to the order block and then to sell from the order block, but I don't advise it. I advise waiting for price to trade into the order block and then selling from the order block. That's what I advise. Why? Because even though price trades away from the order block, this is an indication that price was to go down. What you cannot guarantee is a retest of the order block. Although, yes, we can anticipate it and we're ready to act if price were to do that, but it's not a guarantee. So why would you want to buy into a scenario where the likelihood of it working out is a lot less than if you were to sell from a high volume area? That makes no sense, right? So yes, it could work out now, but if you were to do the same thing 10 times, it will probably only work out 2 or 3 out of the 10 times, and the odds are against you. So there's no need to do something that you kind of repeatedly do and make money. That's my rule in trading. So in this case, price was falling away, but the best thing to have done was, rather than trying to look for a long to trade into the order block, would have been to wait for price to trade back into the order block and then seek to trade that continuation to the downside. So I waited for that up until the end of my trading hours, and that didn't happen. So what did I do? Called it a day. There was no trade. It happens, right? Last week, we had a trade every single day, and every single day was a profitable day. It was fantastic. So usually after weeks like that, I anticipate a week of price, being fishy. So we had Monday. It was an amazing setup. First entry was a loss. Second entry gave back that money that was a loss plus profit on top. Tuesday, no setup whatsoever, even though we've been sitting around waiting for that setup for the whole day. Wednesday, exactly the same thing, right? Waiting around for that setup. Again, price shifted, no setup at all. Now, at this point, this would test the trader's patience. And if you're an amateur, you're going to be looking for trades where they don't exist. You're going to be looking to pay yourself for sitting down for 4 or 5 hours, and you're going to be looking to take nonsense trades like going long, for example, when you shouldn't go long, and losing money unnecessarily because price was like, no, I do not want to go up. And it was just accumulating for a bit, and in New York, it just kept on falling. So a patient, disciplined trader would always follow the rules. If it means only taking one trade in the week as a day trader, there are going to be weeks like that. There are going to be weeks where you take trades 5 days a week. There are going to be weeks where you take trades only twice a week, and you need to be prepared for that. So Wednesday, no setup whatsoever. Okay. I know, Jimmy, you went short in the scenario, and I understand why you went short. You were looking at the break on a lower time frame perspective, which is okay. But one thing to remember is the reason I personally don't do that is because repeating that behavior would only result in a loss over time. Because the vast majority of the time, if you do not watch the 15 minutes time frame for a breakout and you're looking on the 5 minutes and the 1 minute, you're going to end up getting into a trap, right? And when I talk about traps, I'm talking about scenarios like this. So let's say that you thought this was a breakout and you went short in this situation, right? And then price came back up and your stop was, I don't know, somewhere low, or price came out and took out the recent high, you would have been stopped out for no reason. So avoid being in the market when it's still trapping around the Asian range. Always wait for price to break outside of the Asian range before engaging in the market. That is going to lead to a much greater likelihood of being in a profitable position. Okay. Any questions about this? Perfect. No questions. Move on to the next day, Thursday. Now, Thursday was the juicy day of the week. This was the day that made the weighted around on Tuesday and Wednesday very, very worth it, because on Thursday, my risk to reward was a 1-7. I was able to grow my account by 1.8%. So it was a very, very nice day. So if we take a look now, Thursday, just going to identify the levels. Right, so we have here our sell side target. So a daily sell side target. And then we obviously have our buy side target, which is down here, up here, sorry. Just going to label this. Why is it not labeling? Daily buy side target. There we go. All right. For whatever reason, it's choosing not to label. That's okay. So going to the 4-hour time frame. So of course now, so just to touch on the daily. So what was your perspective on that day? Very simple. 3 sessions of rise. We've seen price accumulate. We've seen price giving that session of drop. So we can anticipate one of two things at this point. Number one, we're still within a predominantly bullish cycle, right? So we know that price is taking out these equal highs. There's a likelihood it will also move to take out the daily high as well. That's fine. So we've seen a session of drop. We know that within the reversal phases of a predominantly bullish session, price might reverse only for 1 or 2 days before giving that continuation to the upside. So here's a good way to identify a potential reset. If usually in the open of the session or in Asia, price goes for the sell side target of the preceding daily candle just before the London Open, then it's likely that we could see that bullish continuation. However, if in Asia, we see price trading, not taking out the sell side target, maybe leaving a set of relative equal highs, and then trading into the body of the previous day's candle, then we can anticipate a potential move to take out the sell side, which is the low of the previous day candle, before a potential bullish continuation. So I usually like to see how price moves in Asia before the London Open, which allows me to properly identify or anticipate how the price may move within the London session, right? So just going to forward play this. All right, so H4 sell side target down here. Again, I know the labels are wrong. That's fine. No, that's not what this is about, right? So it's just really just replaying the day and just running through what you should have been looking for within that specific session. And then we have here the H4 buy side target. 1 second. All right, so my trading view has now decided it doesn't want to cooperate anymore. That's fine. I can work with that. That's what I do. All right, going down to the 1 hour time frame. So E open, London open. There we go. I think the clocks go forward in the UK this Sunday, I think, if I'm not mistaken. So that should allow us time to catch up. All right, so next thing, of course, was to identify that Asian range. I'm not sure why it's not there. Oh, sorry, because I'm on the 1 hour time frame. There we go. So very tight Asian range within the session. Tight Asian ranges are good, by the way. Why? Because if you have an accumulatory Asia session, then the trading day is probably going to be an AMD day. I love AMD days. AMD days are the money maker days, because all you're then looking for is an accumulation to, or whatever side price breaks out of the Asian range, doesn't matter. If price breaks out below, then you're looking to go long. That's your money. If price breaks out above, you're looking to go short. That's your money. So it's a very simple day to trade when it's AMD days. You're not always going to get that though. Some days you're going to get price trending in Asia. So regardless, we had a AMD day where price was accumulating through Asia, and then London Open, we had a nice bullish break above the range. That's fantastic. Why is that fantastic? Because what did we say? What did I say earlier? I said, if on the day, if price, for example, trades into the previous day's candle, then I can confidently go short towards the low of the range of some sort, or towards the previous day's low. But if price trades in Asia, for example, and took out yesterday's low, then in that scenario, short would have been, long would have been the most ideal scenario. So what we've seen is price accumulating in Asia, taking out, trading into the body of the previous day's candle, giving us that AMD model. So in this case, obviously short was the most optimal setup. So the confirmation to go short was quite very simple in London. We had obviously price delivered the initial high. Actually, I'm just going to talk about a few things. Sorry, just a second. So this is now obviously an AMD model, but it is still a BRR setup as opposed to a purge reversal. Now, I know some of you guys have not really done the full content on the difference between a purge reversal and a BRR, for example, but there is a slight difference, and it's a very important difference. So with a purge reversal, right, what we usually would see is price trades from the low of the range and vector accelerates to the high of the range in a series of candles, in a series of moves. So like this, for example. But it will come directly from the low of the range. So it will be the new low that forms, and it would vector accelerate. Now that's a purge reversal scenario. Now a purge reversal scenario, I just look for an entry on the 1 minute time frame to go short, right? So that's simple. Now a BRR scenario, on the other hand, is a little bit tricky. The reason being is because rather than coming from the low of the range, price creates a bullish order block in the Asian range and then vector accelerates outside of the range. Now, in this case, you're obviously not going to just be looking at this as a BRR. It could also potentially be a BRC, right? Where price could retest the order block and then keep on rallying, right? But why are we BRR today? 2 reasons. First is we anticipated it because of the daily bias. The second reason is because of price action. So usually with BRR confirmations, and you can always go back to your backtesting flashcards and review this. you usually would see price giving that vector acceleration. There's very strong candles outside of the Asian range from the bullish order block, right? Because normally usually with BRCs, you might see scenarios like this, where price gradually trades outside of the range from the order block, retest the order block in London with an aggressive shift candle, right? Again, that induces traders to sell before giving that nice bullish continuation, right? But then with this scenario, what we're seeing is that vector acceleration. Remember, fast moves brings money into the market, right? Inducing traders to go long. And this is the clear sign that we could be looking at a BRR scenario. So using our daily bias, also the H4 bias and H1 bias also helps, right? But the price action is the most important confirmation of how price moves outside of the range. So in light of this, now with BRR scenarios, I usually prefer to enter confidently on the 5 minutes time frame. You can take a 1 minute confirmation. You most certainly can take a 1 minute confirmation. But the risk with a 1 minute confirmation is price could simply, so you could get a 1 minute confirmation short, but price could trade into the order block, potentially giving a 5 minutes confirmation. But because you're not looking for a 5 minutes confirmation, you might miss a very an indicator that price might actually be looking to retest and bounce off the order block. For a lot of you guys that have actually been through the program, what do you think that indication is that you might miss if you weren't looking at the 5 minutes? That could be a telltale sign that actually price might be looking to go back up. Does anyone want to guess what the answer to that is? Not guess. I don't want guessing, but you know the answer to that. So if you were looking for a confirmation to sell on the 1 minute, but you weren't looking on the 5 minutes, what is the 5 minutes confirmation that you would have missed that could have given you a sign that price actually might not be looking to go down? It might just be looking to bounce off the order block and go up, because there's actually an indication of this, of a BRC. Right, and what does it leave? Unmitigated zone. That's it. So, because what usually would happen is price might give a 1 minute confirmation, retest, and then drop. But then you get a 5 minutes confirmation, but then price doesn't retest the high volume error. So it neither retests the imbalance or retests the order block or retests the breaker. It just gives a break of structure, but keeps on dropping. In that case, what you have is an unmitigated zone. Now, as a rule of thumb, if price was to give a confirmation and fails to trigger an opportunity and leaves an unmitigated zone, that's an indication that price might be looking to actually trade back in that direction in the near future. So like within the next few hours or minutes. So this is why I prefer to enter, or I'd rather look for, as well as a confirmation in the 1 minute, also prefer to look for confirmation in the 5 minutes that actually triggers an entry, because that way, that gives me confidence that if price is mitigating as it's falling, all right, and it's balanced, and essentially what that means is they're balancing their books as they're falling. That is your very clear indication that they're looking to keep on pushing price downwards, right? Why? Because they're balancing the books as price is moving down, which is good. But if the books are unbalanced as price shifts, that's an indication that it might be looking to go back there in the near future. And we had an unmitigated zone earlier this week that gave us an indication that price might be looking to go up at the end of the week. Because again, remember, the market is a fractal theme. The same thing plays over and over again. Remember what happened on Tuesday, right? On Tuesday, we had a big shift and price didn't trade back to give us that trigger. But that, again, is your unmitigated zone. So that should have given you an indication that, ooh, the next day, what did price do? Price came up, traded back into that direction. So again, when you get days of trading where price actually gives a shift outside of the range, but it fails to pull back into the order block to give a confirmation, that's an unmitigated zone. So you should now be thinking, well, I could take advantage of this later in the week because there's a likelihood that price might be looking to come back to this price level in the near future. So this is something I could be taking advantage of. So always think, so whenever you see an unmitigated zone, it's usually a clear sign that price might be looking to come back to that area in the near future. So that's why with BRR setups, in order to not get mixed up with BRRs and BRC scenario, right, it's always nice to take that BRR setup on the 5 minutes time frame. So 5 minutes time frame, we had a classic break of market structure. You could have done a 5 minutes, you could have done a 1 minute, up to you. But after the break of market structure, what I did is I went on to because I'm always looking at the time frames at the same time anyways. After the break of market structure, to identify that nice juicy entry spot, I can see that after the break, there was an imbalance there. So for me, the optimal thing was to go short at that imbalance rather than trying to go short all the way down here. Just to, the more you trade, the more you're trying to always refine and ensure that you can have a nice risk to reward ratio where the opportunity presents itself, right? So stop loss goes 5 pips above the recent high. First profit target on this day. So if we go back to the 15 minutes time frame, right? So first profit target, I remember saying, was the low of the Asian range, was also where the H1 sell side target was. But now the second profit target was where I made a slight error in judgment, because I remember the second profit target, I was looking to go back to the H4 buy side target. But there's one thing to always do. If the distance from the first profit target, which is the 1 hour usually, to the second profit target is quite wide, right? And I know it's like, okay, what defines wide? How many pips is wide? 20 pips, 30 pips, 40 pips, 50 pips, a variable. But I usually look, okay, it's quite a wide distance between the first profit target and the second profit target. What I would usually do is I would go, again, specifically on the 1 hour and the 4 hour time frame, is I'll go on the 1 hour time frame and I would mark out intermediate lows or intermediate sell side targets where price could potentially react of, and I'll be looking to take profit there instead of just keeping my fingers crossed that price would run to that H4 buy side target. And I remember doing this, but for whatever reason, I completely missed this imbalance. This imbalance is actually quite key, right? But what would have been an optimal second opportunity of taking profit? So the first was, of course, the H1 buy side sell side target. The second one could have been the short-term low residing just below. But the most ideal opportunity to have taken your final profit would have been the imbalance. Why? Because there was confluence with the imbalance and the 800 EMA on, I think it was the 5 minutes time frame at the time, because 800 EMA is quite key, right? You guys already know the 800 EMA acts as a dynamic area of support and resistance for price over multiple time frames. So just imagine the 800 like this, like a magnet, always constantly pulling price to it whenever it goes far away, but whenever price gets to it, pushes price away from it, right? So 800 EMA acts as this dynamic support and resistance where prices, for whatever reason, always gravitating towards it and pulling away from it. So I always look for confluence with buy side and sell side targets alongside the 800 EMA on the 5 minutes and the 15 minutes and the 1 hour time frame. So those are the 3 time frames I monitor with the 800. So 5 minutes, 15, and 1 hour, not the 1 minute. Okay. So there was confluence with that imbalance as well as the 800 EMA, which made it an optimal area to have taken that second profit of the day. So anyway, so there's a very clear entry opportunity on the 5 minutes, a very clear trigger when price traded into the imbalance. With a very nice risk to reward ratio, you could have at least achieved that 1 to 2, 1 to 3 risk to reward ratio on the setup, right? And then eventually price traded into the imbalance and then traded away from it. Now, I did mention I got a 1 to 7 of this on this day. And the reason for that was because there was a twin setup on US 30. And what I always do is I monitor pound dollar and US 30 simultaneously, because usually US 30 gives that bigger moves. If it gives a twin setup, there's an if, not always, but if it gives a twin setup, usually there's like a bigger move on US 30 that allows me to make like 1 to 6s, whereas, pound dollar might just be a 1 to 3, right? So what I do in those situations is I split my risk between both of them, and then I maximize as much as possible my risk to reward ratio from the correlated movements between pound dollar and US 30. But we're not going to go too much detail for now about that. So for now, because the most important thing is mastering how to trade pound dollar in the mornings. If you master that, then trading the US 30 is literally a walk in the park. Because all you're doing is correlating the movements in both pairs when they're looking for correlations when they do align, because they don't always align, but they do align majority of the time. So anyone has any questions about this setup? It's a very straightforward setup. I know a lot of you guys got into the setup and at least took that first profit target at the low of the Asian range. But again, just in the future, just pay very close attention to intermediate highs and intermediate lows between the H1 and H4 if there are any present, and looking for that confluence with the 800 EMA on the M1 and the M5, M15, and H1. Do not ignore those situations. Any questions about this before I move on to Friday? All right, no questions. We'll go on to Friday. So looking at Monday to Thursday, perfect week of, let's say you had this perfect week of making perfect decision, right? Then Monday would have been a day with no trading whatsoever, with a setup. One of would have resulted in a loss, and you would have made that money back in your re-entry. Tuesday, no setup whatsoever. Wednesday, no setup whatsoever. Thursday, we have a setup. That setup, again, you did a 1 to 2, 1 to 3, 1 to 4, depending on how you enter the market. And now going into Friday, right? We've now seen prices giving us that second session of drop. We've seen prices traded towards the low of the previous day, but not taking out the low of the previous day, and then traded back into the range, right? So again, we're still playing the theme buy side to sell side. Prices taking out buy side above this prior highs. Prices now taking out sell side within this imbalance and also within this imbalance. And then the next day price didn't trade below yesterday's low, but rather traded into the body of the previous day's candle. So was that an indication of what could happen? So one of two things. Prices had given a break of market structure on the 4-hour, 1 hour, and we're looking at a reset scenario where price could give us that bullish continuation to the upside, or we could get a session of price aggressively falling to take out the sell side liquidity that's building up between yesterday's low and the low of Wednesday, trading a little bit deeper into daily sell side before we see that potential bullish continuation to the upside. So in scenarios like this, where the daily time frame, because there are times when you look at the daily, there is no ambiguity, right? This should be most of the time. But there are also times when you look at the daily and it's quite ambiguous. This is one of those cases where the day didn't take out buy side or sell side. It just traded in the range of the previous trading day. So that means price is still accumulating within the previous day. So these are ambiguous days. So with ambiguities on a daily, the best form of analysis is usually going to be your lower time frame analysis, your 4-hour, your 1 hour. So daily sell side being this imbalance. We have obviously a very small imbalance there, which was our next drawn daily buy side. So I'm just going to move this line just to indicate the beginning of that imbalance. So going into the 4-hour time frame. So 4-hour, what we're looking for is that H4 sell side target. So again, relative to where price is, I'm just going to delete this box as well. The next draw on sell side liquidity is going to be, so it was the swing low down here. And we can see the next draw on buy side liquidity is going to be the swing high up here. Okay. So we go down to the 1-hour time frame. There we go. So next draw on buy side on the 1 hour was the swing high right here. And the next draw on sell side on the 1 hour, 1 second, just going to grab this, just move that there, was our imbalance down here. Okay, so we had this, I'm not going to use the box on imbalance just to save some time, but we had this imbalance down here. We had the swing high up there, we have the swing high up there, and we of course have our H4 sell side, which is the swing low down here. Okay. All right, so going to the 15 minutes time frame. So what did we see on this day? Well, yesterday. Well, we had a very small range. We had a bullish Asian session. You typically speaking, bullish Asian sessions are a sign that we're going to have a bearish London session. Okay. So again, it's quite simple how to use Asia, right? So if price accumulates in Asia, then you can anticipate AMD. So for price to either manipulate in the open of London, therefore giving us that bearish bias, or to give us a bearish manipulation, giving us a bullish distributor and bias. But if price was to be bearish in Asia, we usually can anticipate some so if price was to be bullish in Asia, we can anticipate some bearishness in London. Whereas if price was to be bearish in Asia, we can anticipate some bullishness in London. It's quite simple. So seeing this, we've seen a bullishness in Asia. We've seen a very small range that formed. I've identified where my order block is, right? Now, in this day, the most optimal setup would have been to go short. That's the most ideal opportunity, okay? But we don't know where price would be in the London Open. So London Open, we can see we have a break scenario. We have an order block, right? So what I'm anticipating, if short is the better direction, I'm looking to go short as a BRR. And with a BRR scenario, I'm either going to be looking to, so price is taking out H1 buy side target. So what I want to see in London is for price to take out the high of European Open, as well as this potential high, even better for price to take out the H4 buy side target, right? And then I look for a 1 minute confirmation to go short. That's the first opportunity. The second opportunity was for price to trade into the bullish order block, respect the bullish order block, trading into the buy side target, and then we see sort of a bearish continuation. So these are two scenarios that I considered. Now, there are other variations of a BRR that you could consider as well. So with BRRs, you have BRR on the 1 minute, which is where price takes out the recent high, and then we look for a 1 minute entry. You have BRR on the 5 minutes, where price, rather than taking out the recent high, where price breaks structure on the 5 minutes time frame, and then we anticipate a retest and a continuation. And we have BRR on the 15 minutes, where price breaks structure on the 15 minutes time frame. And then again, we have the same thing. We have a retest of a high volume area, and we have a continuation to the downside. Now, on Friday, I missed one crucial confirmation for the BRR because I was looking for a short confirmation to sell, but because price at the beginning of the London Open traded into the bullish order block, right? The bias for me was, okay, I want to see how price moves from the order block to whether if price was to trade back into the H4 buy side target or the recent high. So what did I do? And I know Shane, you joined in on this trade, and John, you did as well. So I waited for, so the initial confirmation was price touched the order block, gave a break of market structure, and then failed to rally and then took out the low. The second opportunity was to wait for price to take out the low of the order block. Again, gave that break of market structure again, retested the last down close candle, because that was a classical break of market structure, and yet again failed to take it out. But what was the thing that I got wrong? Well, number one, it was the best direction to have traded today was bearish, and it's always good to trade in line with what all the indications are telling you to trade in line with, right? And the most important indication out of all the indication is how price moves in Asia, right? So price is bullish in Asia, being bearish in London is just optimal, it's ideal. But there are three types of BRs that I identified. What is the one BRR setup confirmation that you guys think? I personally, and if I don't know, maybe you might have seen this yourself, but what do you think was the most optimal setup for this day? Anyone? And then price actually gave a nice entry fill before proceeding to give that rally to the downside, that continuation rally. Yeah. So what was the time frame to have identified the BRR opportunity on that would have given an optimal opportunity to trade in line with the Asian bias? So you said the 5 minutes time frame. Now, the 5 minutes time frame, the only issue that was wrong with the 5 minutes time frame was that price. So this would have been a secondary break of market structure, right? Because price obviously gave this initial low, contracted, right? And then obviously this is your break of market structure on the 5 minutes, where price broke below that low, leaving a slight imbalance right there, right? So yeah, so it could have gone short from the imbalance. I think, John, you mentioned this as well. Could have gone short from the imbalance price. Stop goes above the high. But for me, the reason I was hesitant in going short was purely because price hadn't taken out that H4 buy side target, which should have been a very strong indication of a strong bearish move to the downside. Again, it's not just about any bearish move, it's about a sustained move in a specific direction for that trading day, right? But then also on the 15 minutes time frame, right? What is there to see? Well, we can see that this is where the initial high was. We can see that price created an intermediate low and then gave also a secondary break of market structure on the 5 minutes time frame, right? So the two things to have noticed, right, on the day anyways, but there wasn't any setup that day, by the way, that was ideal anyways, in line with a short bias. But the two things to have noticed was the fact that price had given a break of market structure on the 1 minute, on the 5 minutes, and on the 15 minutes time frame to the downside. Although none of these opportunities failed to anyways trigger within the session, right? Because let's imagine that price gave this break of market structure and, you know, one went short there in London Open, price came up, pinged your entry and traded down. That would have been nice. But it wouldn't have been a setup anyways. Why? Because if you had gone short at the imbalance and you put your stop loss 5 pips above the high, right? And you went short at the imbalance. All right, so smooth this one. So let's say you went short on the 15 minutes at the imbalance, top goes 5 pips above the high. Your first profit target would have been the H1 buy side target, sell side target. You would have yielded less than a 1 to 2. So it wouldn't have been a setup anyways, because the potential yield on the trade compared to the risk that you're taking to be in that position is just not worth it, right? So even in that scenario, there's no setup. So the ideal scenario for Friday was there was no setup, because the optimal position to have taken. So this was a BRR day, just like Monday was a BRR day, right? No, so just like Tuesday was a BRR day, right? The only difference, we had a BRR 15, a BRR 5 minutes confirmation, but there was just no trigger, leaving an unmitigated zone, right? Leaving an unmitigated zone. And then obviously price kept on dropping into the New York Open, because again, Fridays and Mondays, price can sometimes move in New York instead of London, before giving the move in the New York session of that continuation to the upside. So there were 2 losses were taken on Friday. And I always, so whenever at the end of a trading day, I always reflect on the trades that I take, right? Was it in line with the trading plan? Yes, it was, absolutely. So if you'd gone long at the order block, that was in line with a potential BRC, right? Because with a BRC, you always look to go long from the order block, or you look to sell from the order block. And was the re-entry in line with the trading plan? Absolutely, because the re-entry was only taken after price had traded, taking out the low of the order block. So I was very happy with the decisions I had made that day in terms of my entry confirmations, even though both setups had resulted in a loss, right? But it was a loss that wasn't avoided within the context of the setup itself, right? But then upon further evaluation, I obviously reflected, like, was the analysis correct? My analysis was correct. But what I didn't do was I didn't trade in line with what my analysis was telling me was the optimal direction to trade, which was to sell against the bullish Asia range in the London Open. So it's usually, if price is bullish in Asia, it will be bearish in London and bullish in New York. Or if price is bearish in Asia, it will be bullish in London and bearish in New York. That's usually how it happens. That's how it works, right? So you have the direction, but then I traded in the I tried to trade in the opposite direction of the optimal London move, which obviously resulted in 2 losses. So that was the only side of Friday which I reflected on. I thought, I could have avoided those losses. So yes, it was a loss that was taken in line with the trading plan, but it was an avoidable loss that I could have prevented if, for example, I'd been a little bit more strict on it and said, you know what, although yes, I can see potential retest of an order block, it goes against that Asian range bias. It goes against the Asian bias that was created, which allows me to define the London bias of where price could potentially shift. But again, losses happen, right? And in trading, every loss should be some sort of a lesson, right, to you one way or another. So Friday was 2 losses from the initial entry and the re-entry. Thursday was a gain. Wednesday was no trade. Tuesday was no trade. Monday was a loss with a re-entry. So the week was net profitable, still a very good week, right? Obviously, last week was even better because last week we just had great setups every day. But that's one of the beauty of trading. Every week is going to be the same. Some weeks are going to be more challenging than other weeks. It's about being consistent in your decision making and being consistent in your behavior in order to identify and trade the appropriate setups. Okay. Does anyone have any questions about this?